Alrighty, so to be just cognizant of everyone's time, we're going to go ahead and get started here. I'm going to give a very quick introduction to kind of why we are here today. So today, the NMFAST program, which stands for New Mexico Federal and State Technology Partnership Program, we actually are an SBA funded group, let's call it, rather than an organization that assists small businesses that are looking for SBIR and STTR opportunities, development assistance, funding assistance, help them match their ideas, and really get that snapshot of, are they working on something that's innovative? And now one of the big factors that goes into an SBIR or STTR package is actually your budget, your funding, your financing. How are you going to make your accounting system, things like DCAA compliant when you're working with DOD? What are your indirect rates? There's a lot of information that you need to know about your business and about your overall operational envelope whenever you even look at one of these funding opportunities. So today we actually have George Moker with Moker CPA, who's going to give a real good in-depth overview about contracting with the government and how you actually move through those steps, how you move through those opportunities, how you realize what things like an overhead rate is and how you're going to try and calculate those, what goes into figuring out what all are your business drivers and what all are your finance drivers whenever you're looking at your business itself. And also we have Karen Medina and Phoebe Wilson from PTAC. The
Procurement Technical Assistance Center.
Sorry, the acronym escaped me at the moment, brain fart. But from the Procurement Technical Assistance Center, who are actually help businesses find contracting opportunities and help them do a lot of their development and a lot of their really just kind of overall basic information, like what do you need, how do you move through getting it done, a SAM, you know, how do you actually even incorporate yourself within the state, or where do you even find the information to do those basic business drivers like that? So I'm going to actually turn it over now. Karen's going to give you a quick 5-10 minutes about what PTAC does and what their assistance is and how you actually find their assistance. And then George is going to take it from there.
All right. Thank you, Dell. I'm Karen Medina, and this is Penny Wilson, and we work for, as Dell said, PTAC, which is Procurement Technical Assistance Center. And actually, our office is just 2 buildings down the sidewalk. We are in Genesis Building A, Suite 101. PTAC was started, I think, in 1986, and we are funded by the Department of Defense. So we are a government agency funded by the government. And part of our funding in New Mexico also comes from the state of New Mexico. That's usually how it is with these PTACs. They are nationwide, they're in every state. So they usually have partial funding by the Department of Defense and partial by their state, usually. That's how it works. And that's how it is in our case. And we have offices scattered throughout the state so we can try to help everyone who needs our help. We do travel to smaller cities where we don't have offices. We do have an office in Santa Fe, and of course that person up there would cover Los Alamos and Espanola and Taos and those areas. We have our main office in Albuquerque. There are like 4 or maybe 4 advisors there, a program manager, an admin person, and they cover all the areas around Albuquerque, Gallup Grants, Farmington, that type of area. We also have someone in Clovis, and she kind of runs all up and down the eastern part of New Mexico. And then Penny and I are here in Las Cruces, and we cover Silver City, Deming, Alamogordo, Ruidoso, Socorro, Animas, all those types of areas. We don't have to go to those areas that often, but we cover all those areas. What we do and what PTACs do, our services, let me just say first, right off the bat, because we're government funded, our services are free. We help small businesses understand how to do government contracting. And sometimes SBIRs and STTRs fall under that because there are certain agencies of the government who issue SBIRs who will award a contract to the winning proposer. And so if you end up with a SBIR contract, You do have to be in the System for Award Management. That's a government database where all government vendors have to be in that. And also, in order to get in SAM, System for Award Management, you have to have a DUNS number. And we help with that too. And a DUNS number is issued by Dun and Bradstreet. So everybody who goes into SAM has to get that DUNS number first. So we help people do that. If you get online and try to do it yourself, it can actually take days, if not maybe a couple of weeks. Or I've heard the process can be kind of slow. And we actually have a phone number we can call and get it within 5-10 minutes.
Does anyone have DUNS?
Yeah, so we can get it real quick. And then you have to wait 24, 48 hours before you can then let us help you set up your SAM, because DUNS has to upload that number into the whole world, I guess, wherever they upload it to. And then once you are a PTAC client, we help you, like I said, not only with the DUNS and the SAM, but we can help you find opportunities. We have what we call bid match, where based on your NAICS codes, you're matched up to solicitations that you can respond to if you choose to. You get automated emails sent to you about these solicitations that you are, able to respond to. So we help with that. We offer a lot of workshops, and our workshops are always free too. It's like rare to never that we would charge for one. And we also help you if you ever come across a solicitation you're interested in and you're trying to read this government like request for proposal or something, or even a bid, and you're like, I don't know half of what they're talking about. You can come in and we can try to help you understand it too. And one good thing is if Penny or I have problems understanding any part of it, we can bounce off our coworkers in Albuquerque or Clovis or anywhere. They all have different expertise levels. And we have a couple of guys in Albuquerque that are just really good with the cost proposal part of a proposal. Penny and I always bounce off them because we don't want to misguide anybody, and they're just so good at it. They know all about the indirect rates and all that. So we can help with all of that stuff. We also help not just with federal procurements, but state and local. If you're interested in doing business with City of Las Cruces, Doñana County, New Mexico State University, the state of New Mexico, any little city, we can help with all that too.
And that can add to your past performance, because federal government, they're very risk adverse, so they want to see that you have successfully done the work you say you can do. So local contracts are very good for that. People tend to discount them, but local government's a good way to get into it.
It's also a good way to get your feet wet in government contracting. And of course, I'm talking all about government contracting, like you're already going into business to do that. But if you're pursuing SBIRs, don't forget we do help, of course, with that, because you will need to set up a SAM and all that, and we can look through that proposal with you. Dell does that expertly as well, but we also can help with that. The agencies that usually issue contracts as opposed to grants when it's SBIRs, that would be Department of Defense, Department of Transportation, Department of Commerce, the Department of Energy, I think, the EPA. I may have missed one or something. Dell knows them down pat. I have to try to remember them. But they usually will, or a lot of times will issue a contract when it comes to a SBIR, as opposed to a grant, because there is a difference. So, and I wanted to let you guys know that on September 5th, we are having a workshop, and it is DCAA audit training. And it will be at the Doñana Community College, the ACC, I don't want to keep using those acronyms, Workforce Center. So the Doñana Community College Workforce Center over on Nevada. On September 5th, we are giving a workshop from Defense Contract Audit Agency. We're going to have a gentleman named Joe Greger come, and he is a current Defense Contract Audit Agency employee, and he will talk about what would be expected of you should you have any sort of contract with a Department of Defense type of agency. So that's very good information. The Small Business Administration will also be there to support and talk about what they do and stuff. So that's something that we have coming up.
One other thing I wanted to mention about PTAC, we also hold networking events. And if you're new to the feds or to other government agencies, it's hard to get FaceTime. So we hold networking events. We actually hold them in a speed dating format, 10 minutes. You get to give your pitch about what you do and then ask them what they're looking for. We're actually having one in October. And it's on our website. I'm going to give you guys our cards and also just a little card on PTAC.
Yeah, go to our website, which our website is listed both on our business card and on that other card. And you can see everything on our website. Brian doesn't need
Oh,
one,
sorry.
we do have an events calendar on our main website. You can see what events are coming up. So did we leave anything off?
Just come see us. If you
Yeah.
have questions, call.
Anybody have a question? Now that I've raised
Okay.
Okay, well, Dell, I think I've given the 30,000 foot,
No
you know,
problem.
overview of us.
Well, and we work with PTAC quite well and quite often. If you ever have a chance to need any assistance, definitely let us know. We're trying to schedule more of these kind of information sessions and webinars in the future. So we'll start sharing on each other's calendars and items like that. If you ever need any assistance with your SBIR submission, feel free to come to either of us. They may point us in or point you in our direction for a little bit more of the hand-holding and guidance, but that's what we're here for. We just want to see New Mexico small businesses succeed. And now we'll go ahead and turn it over to George. You are ready to go, George.
All right. Do you see my slides?
Yes, we do.
Okay, very good. So I guess good morning, everybody. I'm George Mocher from Mocher CPA, Division of Ambrosi Donahue Congdon here in the Northeast, Newburyport, Massachusetts, about a half hour north of Boston. And I want to thank everybody for the opportunity to speak today and to share some insight and experiences to help you with the accounting system compliance side of federal awards. So we'll be focusing on the financial side and might touch on some legal things, but it'll be on the financial side as we don't give legal advice. So just a quick background. I was on the awardee side of the table a long time ago, and I started with government contracting as a controller, where one of the early tasks in my tenure at that company, aerospace support firm, was that the Boston DCAA office was going to audit a contract that was a fixed price contract, and it was terminated at the convenience of the government, which flipped the contract from fixed price into a reimbursable contract, which means now you need a whole lot of information to prove your cost. And so we learned the hard way of fixed price at times may not mean fixed price. It depends on the nature of the type of contract you get in the program you're involved with. But we had a very, very interesting audit experience. And I came out of that experience saying that if I ever started my own business, I think I would probably look at a better way to work with the government from a small business standpoint. So that was part of the driver. The driver for us, though, business-wise, is that you're a company first and the government just happens to be one of your customers. So everything that we talk about today over the next 60 to 75 minutes is really going to be tied to what are best practices. So what the government does ask you for sounds very onerous, but the reality is that your number one focus should be on your research. Your number two focus should be on the systems around that research to support any costs that are claimed by the government. But all of that compliance component, those pieces are really best practices, and small businesses, regardless of what you get into, should adopt them. But as we know, history will tell us that that's not necessarily the case. My background is I am a CPA. I'm the director of the entrepreneurship program at Suffolk University. I'm full-time faculty there. In addition to founder Mocher CPA, which is now a division of Ambrosi Donahue Congdon. We made that transition back in December. And I'm the director of the government contracting group. I'll bring a lot of experience into this and share some insights to help simplify your life, and also founder of the SBIR Academy, which is a government contracting portal for, we'll say, phase zeros to phase one type of awardees. So today we'll talk about contract requirements and really anything I'm talking about today for those of you who are in the very beginning of the process, if that's most of you, these are things that are really good to keep in mind as you go through your journey. That's the important piece. And too often we don't know where we're going as we go through this journey. And then what happens is when negotiations start and an award is on its way, awardees will tend to react, and then they have to fix things to make sure that their company can afford to pay its bills, primarily on the indirect side. Directs usually are covered for the most part, but the indirect is always the hidden little problem, and there's ways of mitigating some of that. So we'll talk about the accounting system, labor distribution. We'll touch on vendor payments and expense reports, but they're going to look very much like the labor distribution portion we talk about. Various types of billings, and then indirect rates, what types of audits that you'll be looking at, and then the big thing is it's really phase 1, phase 2 budget planning. So what type of budget should you be thinking about? So the first thing that's important is that when you get your award, they're going to be all different shapes and sizes. And it's really important to understand what the standard clauses are to the contracts. There's a lot of legal clauses in there that you can take a look at, but if you look at any of these sites, DOE, DOD, whatever agency that you're looking at, it's always good to pull down their standard terms and conditions. Those are usually incorporated. So most agencies will just incorporate their standard terms. DOD will tend to actually put the FAR clauses in there, or their DFAR clauses in there, specifically listed in their contract. So they're going to look a little different. But get a sense of what those look like as you're going into this to understand what the expectations are as you get a contract. What tends to happen, and again, everything I'm saying is really based on experience, is that organizations will put together a proposal and they will then get some type of notification that they have an award pending. There's then a process of pre-award to go through, which varies by agency. And then they're reacting to the clauses in the contract, and they'll start to read at that time. You might as well know what you're getting into as you're going through the proposal process. Also understanding what the budget period is. What is a pre-award cost? Which agencies allow for that? And then what types of flexibility do you have in the event that you're running out of time but you still have more work to do around modifications and when you're putting proposals together? So not expecting anyone to really understand each one of these things in a lot of detail, just to be aware that these terms do exist and getting a head start on this as you're going through your proposal process. The government will typically offer one of 3 types of contracts. And the question that we always get in the beginning is, well, what type of contract do you want? Well, a lot of times you don't have a choice. And the government really does make the determination based on each agency of what type of contract to give you. So for example, if you're working with DOD and you're in a phase 1, you will most likely get a fixed price contract, which means if you deliver what you said you were going to deliver, you get paid the payments based on the deliverables. So it might be reports, it might be an end of contract report, but you'll get paid the dollar amount over whatever the payment schedule is, and the total contract is fixed. So there's no other support that's really required on the cost side after award. You're just demonstrating that you delivered what you had said you would deliver, and you're meeting the scope of the contract. On a cost plus fixed fee contract, though, which you'll normally see in a phase 2, those costs are costs that are accumulated in your accounting system, and they're rolled up into some type of billing mechanism so you can get paid. That's where there are auditable situations where the government wants to, they either have additional reporting, they have compliance audits, or they may just have a incurred cost audit. And again, varies by agency. So if you're doing work with NSF will have a phase 1 that's fixed price, and then phase 2 may be fixed price, maybe a reimbursable type of grant. If you're working with NIH, they really tend, on the grant side, they tend to be reimbursable all the way through. In addition to their anything that comes with the Health and Human Services in the form of a contract, those are normally reimbursable type of contracts. So if you deal with NIH, you're going to have a reimbursable situation. Again, meaning that you have to accumulate your costs first, apply your indirect rates, apply your fee to the extent that you have a fee in the budget or the program allows a fee, which SBIR does. And then at that point, bill that amount. So you draw the money down through their payment management system. And then sometimes, and we see this usually with the Army, is fixed T&M contracts where they will take your total award proposal, so your total proposal of, let's say, $200,000 or $150,000, and they'll divide it by the total number of hours that are put in the budget, and then every time you work an hour, you get reimbursed that dollar amount. So it's fully loaded, includes materials, very complicated to manage internally. If you have an opportunity to avoid those, I would recommend avoiding them because they're tricky. If you have some upfront direct cost you need to pay for, because you're not going to get reimbursed until you spend an hour of labor of some sort. So it gets a little precarious as you're running the business from a cash flow standpoint. Your grants and contracts will come with a ceiling amount. So here's the total amount you can get. The question we get frequently is, well, what if it's not enough? That's the dollar amount. Some awardees do go back and try to negotiate. That's what options are usually for. But we don't see any real flexibility on whatever you get awarded, you get awarded. The type of award you have, the trickiest agency to work with when it comes to type of award is DoD. They will tend to give you a fixed price contract for part one, so it could be their first line item, and they might give you a reimbursable contract for line two because you've now demonstrated you have an adequate accounting system. So there's some of those little quirky things that go on. And then the other part is your contract budget, working within your budget. There are limitations to some of these awards. The biggest one, obviously, is DoD, where there's a 15% fixed fee retention. But again, this is all knowing about the language in there, because bottom line for small businesses, it's going to be about cash. And it's going to be about managing your money. If you don't have external funding coming in or supplemental funding coming in, and your company is standing as an organization that is completely dependent on the award, then you want to tread very carefully in how you plan your expenditures. And there are mechanisms where you can plan. So knowing these things as you're going into the proposal process are very helpful for those of you that are already in a proposal process or have received early stage awards. This is something to look at for follow-on awards or opportunities. The agencies tend to work a little differently when it comes to getting paid. So if you're looking at a few of the perfect worlds, as far as agencies, those of you who work with NSF, when you're in a phase one, it's almost like hitting the lottery. You'll end up with a very large fixed price payment, usually $200,000 on a $225,000 SBIR phase one. But on the back end, you got to wait for your final $25,000. So as much as you have cash flow in the beginning, the trick is making sure that you have enough cash flow to get your organization through, waiting for the final $25,000, and that's based on acceptance of your report and your award closeout. DoD will use the workflow or IRAP, and you'll upload a bunch of documents to them, and they will go through the approval process. They'll look at the reporting, they'll look at the financial, which is usually some type of invoice, a 1034, 1035, a standard form. And then you'll get paid usually within 14 days. The first ones are tricky. Those are the ones that tend to get scrutinized the most as they're going through the review process once you upload. And the auditors will take a look at those a little more carefully on the first one or two vouchers to make sure you understand what you're doing. At that point, you're normally smooth sailing. No guarantee that you get paid within this 14-day window. Sometimes it goes to 30 days, which is the government standard terms. And they usually will not go beyond 30 days because they don't want to pay any interest. The perfect world tends to be NIH, where NIH, you incur costs, you add your indirect rates, you add your fixed fee, you go to the payment management system, you put your request in for your money by 5 o'clock Eastern time, and it's usually in your bank by 12:01 in the morning. And so that way there you can plan your expenditures more timely, and it works out much better. DOE, if you're using the ASAP system, that's their system, you may have to wait a couple of days for the funding to come in. It's electronic, very similar to NIH as far as pulling money down. But the reason I'm bringing this to your attention is depending on the agencies that you're going to review solicitations for, so RFPs, and the ones you're going to propose to, you also want to be aware of how you get paid. And if your organization can't get through the first payroll cycle or second payroll cycle in cash flow, then you're going to come out of the gates immediately cash strapped. If you're working with the DoD, you're going to come out in much better shape at NIH. But again, just knowing those pieces. And what we call it in our firm is how do you manage the portfolio when you have multiple awards from multiple agencies, multiple types. On the reporting side, there are agencies that require quarterly reporting. So energy requires quarterly reporting, the SF425. USDA requires that, and NIH requires the quarterly FFRs and closeout FFRs. When you're working with any agency where you have a negotiated rate, you're going to do a proposed final indirect cost rate, which is really just a true up. You're settling up on, here's what we requested from the government, here's the rates we got from the government, here's the reality of what happened financially, and then you propose as your final cost, and the government will either audit you, or they'll do a low risk review, or they just may accept what you have, and that is at their discretion. But your accounting system needs to be able to track all that. And then for those of you working with primarily DoD, but other agencies where you have a rate that's negotiated, NIH will do this too, you have to project your following year rate and then request a rate letter for those agencies. However, that tends to be hit or miss sometimes. Sometimes the government negotiates, sometimes they don't. And you may end up using your previous billing rates until such time as they're quote unquote approved. Any questions on what I talked about so far, and feel free to jump in. There's also, for those of you who are online, there's a chat box that you can put some questions into, and I'll see those pop up on my screen, and I can work with those. Any questions? Okay, that was the easy part. So now we have the fun part. This is the part I love the most. Adequacy of an accounting system. And I'm only kidding about loving that the most. Adequate accounting system in the government world requires really three types of costs that are really looked at. There's allowable costs, allocable costs, and reasonable costs. So we look at allowable costs. Allowable costs in general are costs the government will reimburse you for as long as they're within the award amount, so you don't go over the actual award. Now, if you're in a safe rate or safe harbor rate, depends on what agency is. So if you're using NSF's 50% salary and wage rate, or if you're using NIH's 40% F&A rate, then in that case the costs become a little less important, because as long as you're at the 40% level, you're fine. NSF, it's fixed price for the most part anyway. They may become less of an issue. But bottom line, the government reimburses you for allowable costs up to the limits of your award. So that means if you've got an award for, let's say, a phase one for $225,000, then you have your indirect rates that are built into there, which are usually some type of safe harbor in the NSF, NIH world. DoD, DOE, you're going to have some type of rate negotiation. The government will reimburse you for those. In order for a cost to be allowable, it has to be allocable. That means there's a benefit to the government. So the government shares in the costs that occur. So if you have things that are completely unrelated to government work, they are solely for other types of activities going on in the organization, usually commercial type of things, then at that point you'll be getting into costs that might be deemed unallowable, and therefore you couldn't recover those costs or use those costs in your indirect rate calculations. And then there are unallowable costs, which is FAR 31.2. That's a good place to look for these. And these are costs that are specifically unallowable regardless of what you do with those costs. So they have definitions of various costs like bad debts, lobbying, interest expense, charitable contributions. There's a whole array of costs that, for the most part, whatever you try to do with them, they're not going to be allowable. So if there's no allocability to the government and they're specifically unallowed, then you have unallowable costs and you won't be able to recover those. Reasonable is a little bit of a trickier one. So for example, not every agency puts out standards of what is reasonable. So it's just using good business judgment. Bottom line is government gets the best price. So you got to do your best to get them the best price. And that's on the procurement side. But salaries are usually an area that are scrutinized. So NSF does a very, very detailed review of salaries to make sure there's strong justification, and they tend to just change your salaries to what they think is normal as you're going through your negotiation. NIH has the executive salary limitations, which change like every year or so, where they will say this is as high as your executive compensation could be for direct purposes. So anything above and beyond that's deemed unreasonable or exceeds a limit, those would also be unallowable direct costs. And the accounting system needs to track all of these things. The direct costs, so this would be your direct labor, direct materials, direct consulting, subcontract, and so forth. They need to be broken down by project. So usually a grant, the government calls a cost objective. That's usually a contract or grant, or it might be a specific task within a contract. But your accounting system needs to track all of that, and then having your data centralized. And this is usually where the wheels come off. So most of the things that we see come in are accounting systems that are on QuickBooks Online, which we do not recommend because it's not robust enough for job costing. We'll see a lot of Excel analyses. Nothing ties into anything, and the chart of accounts can't segregate costs between direct cost, indirect cost, and unallowable costs. And that's usually where the adequacy becomes a problem in the accounting system. Questions? Somebody's baby has a question. All right. Adequacy of the accounting system includes the ability for your accounting system to have cost pools and cost bases. So if you think about indirect costs, they're not necessarily dollars when you bill the government, they are percentages. So you apply percentages to your direct costs as you're charging the government, as you're getting reimbursed. So for example, if you put in a proposal that includes, the most common we'll talk about are going to be fringe and F&A, if you're doing NSF and NIH and DOE, and then DOD is going to be overhead and G&A. When you fill those little boxes online that say, oh, what's your fringe? You put in dollars or percentages. What is your fringe percentage? What is your F&A percentage? What is your overhead percentage? And they'll give you a list of maybe 3, 4, or 5 percentages, depending on the agency. And when you start filling in all those blanks and put percentages in there, you start establishing what your indirect rate structure is going to be with the company, and your accounting system needs to track those costs. So my advice to everybody is keep it simple. So if you're in the NSF, NIH, DOE world, have a fringe and F&A rate. So just keep it nice and easy when you do your proposal. NSF might call it fringe and indirect, but stick with fringe and indirect, 2 rates, no more than 2 rates. If you're on the DOD side, go in with overhead and G&A. Your fringe will be included in your overhead, but go in with 2 rates, and they'll call them overhead and G&A when you're going through the application process. Don't use material and handling, don't use all these little funky things, because the accounting system has to be able to track whatever it is you said that you're going to get out of this as far as how you get reimbursed. So that's important. So the cost pool is the numerator of the rate. The denominator would be the cost base. So what is it that we divide by what in order to compute a rate? So for example, if we are looking at our fringe cost pool, our cost pool will include vacation, sick, holiday, employee benefits, payroll taxes, workers' comp, 401k match. Throwing those out there as those dollars become the pool. The denominator is going to be all of my labor minus the labor included in the fringe cost pool. So it's going to be my direct labor, my overhead labor, my G&A labor, my R&D, independent research and development labor, my bid and proposal labor, whatever labor you have minus the fringe labor, that's your denominator. You take those 2 numbers, divide one by the other, and that's your fringe rate. And that is what you've actually earned for your fringe cost. But if you notice, your accounting system needs to accumulate those 2 numbers in order for you to demonstrate that this was my actual fringe rate versus this is my provisional or temporary fringe rate, which we'll talk about a little later. When we look at overhead, your overhead costs are normally, if your fringe costs, they would include facility type of costs, and then other overhead specific types of costs, and that's divided by your direct labor, your base would be direct labor, independent research and development labor, and your bid and proposal labor. So the accounting system would need to have at least those 3 labor accounts and then have a pool designated as overhead. And then that computes your overhead rate. Your G&A would be whatever, G&A is by definition administering the business as a whole. So when you're administering your business, it's going to be those costs, that's accounting, allowable legal, state taxes, G&A labor. So it could be human resources. It could be a controller. It could be part of the founder or CEO. Those items become the pool, and the base in G&A is normally everything else. Everything that excludes the FAR 31.2 unallowable cost. But other than that, it's everything else. It's called total cost input. F&A, facilities and administration, works the same way as G&A does. And then I put other there because I've seen some really creative indirect rates that make absolutely no sense. It just brings complexity into people's lives, but I throw it up there anyway. So goal here, don't be creative. You want to really go to a 2-rate structure. Some companies will go to 1 rate. I don't recommend that. You want a little bit of flexibility. And again, because we're looking at best practices, using these types of rate structures are easier to manage your company as your company starts to look at commercial opportunities. So you're able to price out or cost out what commercial opportunities can be as a result of your federally funded efforts. And then 2 of the little oddballs on the lower right-hand corner, IR&D and bid and proposal, they're treated a little differently. What they do, they're technically G&A costs, so they go into your G&A numerator, but they pull down your overhead costs. So just being aware that there are some little nuances. And again, most of you are probably not at this level at this point, and that's okay. Just be aware of it as you're putting together your proposals, and we'll go into a little bit of the proposal strategies later on. So the chart of accounts is your accounting system. You should have accounting policies and procedures. These should be in writing. The government gets very, very excited when policies and procedures are in writing. When you write these policies and procedures, it's say what you mean what you say. So in other words, if the written policy says you do things this way, you have to demonstrate this is how you do it. Otherwise, you could run into an inadequate accounting system. You need to track costs by direct, indirect by whatever indirect cost pools you have. So that means fringe, F&A, or overhead and G&A. You need to have an unallowable area, and then government versus commercial, and then you need to have a job cost system. This is what usually throws QuickBooks Online out there. So those are some of the general rules we have is 1, use QuickBooks Desktop until Online gets there with their job cost system. 2, if you have not sent your entity up yet, if you're eligible for an S corporation, you might be looking at that, or a C corp. LLCs are a little quirky in the government world, although they tend to be growing rapidly, only because there's no real payroll when a member or owner of an LLC gets paid. And the third part is your accounting system has to be on the accrual basis, and most people keep it on the cash basis. So those are 3 little tidbits that hopefully help. As far as the chart of accounts goes, you'll see this on every website. If you look at NIH and say, hey, what's the chart of accounts look like? It's going to give you something that looks like this. If you look at DCAA's incurred cost, what do they call it? Their incurred cost submission that's electronic. I think they call it ICE. So it's an incurred cost electronic, I think is what it is. That one there will give you a chart of account, like a sample profit and loss statement with the chart of accounts. It's going to look something like this. But the driver here is that you see the delineation between direct, fringe, overhead, G&A, and for those of you who just use an F&A rate, you'll have 7,000 and 8,000 combined. They compress into being the F&A pool. So that way the accounting years will look a little different in that case, but it's very doable in this sequencing. Any questions before we hit labor distribution and timekeeping?
Yeah, George, we had a question come in. Do you have a recommendation on a particular accounting system?
Yeah, so we recommend QuickBooks Pro Desktop. That's the lowest level version that gives you the robustness in the job cost system. And what we look for, because we do get pushback from the field on this, and we have restructured many data files from online to a desktop version. The pushback is that, well, it does track reimbursed expenses by job, which is true. The trick with online is that it doesn't give you a clean roll-up of those costs into an invoice where you can apply indirect rates and profit. So the desktop version gives you that ability, which means if you're able to generate your invoice in QuickBooks and load it with your indirect costs and fixed fee, you in effect already have your FFR data done, so your federal financial reporting data is finished because the system is already in there. You're able to see what are your billings by award, so that helps fill out pages or pieces of the incurred cost submissions. You have your detailed report by award, so by award, by line, so whatever the various lines are on awards. So it's just much, much more robust. The other part is on the accounting system, and this is going to be counterintuitive, is that we like to synchronize everything in the planet with our accounting system because we can, and it's allegedly easier. The problem with the online, the synchronization, is it puts a whole bunch of data in your accounting system. The government looks at it and they see Uber, let's say 743 times, because each credit card charge for each different region is a different vendor. And so you start to lose control of having really clean, a clean general ledger, which is where your centralized accounting system is. So we recommend QuickBooks Pro. I think it's a couple $100 to go ahead and do it, and then go from there. Let's see. I got some questions. Question, can our proposed budget include the cost of the CPA service? It seems we will need. The answer is it's included in your indirect rates. The accounting system we talked about is QuickBooks Desktop Pro. And let's see, and that's it. All right, so I'll also talk about other things such as labor distribution. There are numerous applications to use out there. The one that we're liking right now is it's called Our Timesheet, and we don't get commission on this. So it's a nice, simple, affordable option, and what it does is it meets the DCAA requirements of how you keep timesheets. So as I go through this whole part of timesheets, there's a few applications, Spring Ahead, ClickTime. There are a series of applications you can use, but the most affordable yet comprehensive seems to be Our Timesheet. We're seeing some of this in the field now. And then it seems like everybody's using Gusto for the actual payroll service itself because of affordability and benefits. So if you add benefits to it, Gusto seems to be much more comprehensive. So those are just some of the popular things that we're seeing. Again, we're not endorsing anything. We're just letting you know that these are just things that we're seeing out in the field. So on a timesheet, the most important thing on a timesheet is the second item where it says timesheet must include all paid and unpaid time. And this is where there are findings or adequacy issues in the accounting system, but findings on the compliance side where there are challenges with, if I'm working on direct activities, indirect activities, I work more than an 8-hour day, how do I report my time? So when you're coming, if any of you are coming from academia, timekeeping is a little looser, the rules are a little looser. These are for-profit organizations, therefore some of the rules are pretty stringent and can get into some legal issues too at the same time if the information is inaccurate, knowingly inaccurate. So timesheets include all time whether paid or unpaid. The reason for that is so you get the right dollars in the right buckets when you talk about what is direct and I get reimbursed by the government, what went into my indirect rates. And the only way that the government feels they can do that, and rightfully so, is that they require all time, and then the ratio of that time gets applied to your gross pay to compute the dollars. So for example, if you work a 10-hour day, and you spend 8 hours on direct activities and 2 hours on indirect activities, 80% of that pay would have gone to the government that you would have billed them for, and 20% would be in whatever indirect cost category where you spent that time. Some businesses, unfortunately, employ the first in, first out method, which means 8 hours, and they take the first 8 hours and it's all direct. And so as you can see in that math, you start to lose the relationship of indirect to direct, which now questions the adequacy of the accounting system. So timekeeping is really where you need to put a lot of focus. If there's a part you want really perfect versus just perfect, it is in the timekeeping side, because this is normally a big chunk of your awards. It's usually half. It's a big driver of how you recover your indirect, so it has this chain reaction. And it's also an area that tends to just create the most financial risk to the organization. Time must be tracked by cost objectives. That would be direct by contract or grant, and then indirect categories. Employees control their timesheets. So employees are responsible for preparing, signing, and changing. If a supervisor rejects a timesheet, they're responsible for making the changes and then documenting the reason for change. A supervisor approves it, must be in ink. Again, this is the manual system. You won't see this on the electronic systems. Your labor must be allocated based on level of effort. So that's the percentage of your hours in relation to total hours. And then electronic timekeeping systems, one, they usually require a written policy. And then two, you want to make sure the system meets these requirements. So when you see timekeeping systems out there, even with our accounting systems, whatever it is that people say is DCAA compliant, I'm not aware of any certification by DCAA that says, oh, we looked at this and we agree. It's that they meet the requirements of the award. So there's always a little bit of risk. Let's see. I'm looking at a question. Yeah, so the question on NSF is how robust does your timekeeping system need to be? My recommendation is always be ready to demonstrate the accounting system fully operational in phase one, but it's not usually an earth ender with NSF on the timesheet side until phase two. But again, you're always at the mercy of anybody who looks at your accounting system. I've had award notices of award where if the accounting system wasn't operational, the government pulled back on it. And that's not the norm, obviously, that's the exception. I always say you want your accounting system operational as soon as possible. So if you have the habit created in phase one, transition to a phase two, and on NSF, when you do your car review, you'll be ready to go in the car review. Thank you for the questions, everybody. Okay, so labor distribution, timekeeping, these are two separate and distinct worlds. And in accounting systems that we see coming in, they're just mushed together. I can't think of a better word because that's what it looks like. They act very, very differently. So when we look at labor distribution, we are looking at what did I spend my time on for which I got paid during that pay period? What did I do with that time? The payroll service says, here's how much money you earned, and here's your gross pay. So payroll service would be a Gusto, ADP, Paychecks. They just process your payroll. They say, here's your gross pay or number of hours times your hourly rate, deduct your taxes, and that's it. On the labor distribution side, it says, of the gross pay you received from your payroll service, what did you spend that time on? So it's really taking those dollars and allocating it to direct labor, vacation, overhead, G&A, whatever you have. And when you're done in the perfect world, those two numbers, gross pay on both sides, should be exactly the same, and they offset each other in your accounting system to equal zero. And that's how you know the system works. Some companies will go ahead and try to allocate with each check without connecting to a timesheet. The whole process starts with the timekeeping system first, and then there's wages that are earned. And then at that point, that's where the payroll service just goes ahead and pays for it. So the timekeeping is where your focus really is, and you're constantly reconciling of the gross pay I got paid, how did I spend the time? So those are the two differences between the two systems. So I put together a little mini example here of an employee that is either hourly or salary, and this is always the challenge. So you'll have to look at the Federal Labor Standards Act for whether or not you have employees that are properly classified as salary, exempt from overtime, salary, non-exempt, or just non-exempt, so hourlies. And so making sure those classifications obviously are proper at the time that you hire any individuals that you hire. So now with that being said, we have this example where we have an employee who earns $25 an hour. He recorded 50 hours on his weekly timesheet, and this was his breakdown. So he has 32 hours that are direct with an SBIR award, and he has the remaining 18 hours as indirect, doing various indirect activities. The gross pay was $1,375. So this is the 50 hours times $25 plus overtime because they're over 40 hours. And if this employee was a salaried employee, the gross pay would be $1,000. So when you go and compute this, just to see the difference between the two worlds, is that for the hourly employee, you can see that the individual had 32 hours of direct labor, so that's times $25. So we would bill the contract or grant $800. Then we had all this indirect stuff, and then we had overhead, which is not a direct reimbursable cost, but it can be in the overhead cost pool. And you can see how the distribution on the left-hand side hourly compared to the right-hand side is very different. So an employee is salaried, it's just the gross pay for that period multiplied by the level of effort. So that ratio of 32 over 50, 32 hours direct over 50 hours worked, and now only $640 goes on the books for your direct labor charge to this SBIR award. So very different numbers, materially different, same person, same exact work during the week. And this is the reason why the labor distribution system is so important, is that you can have significant differences in what you actually report to the government as a claim cost versus what you should have reported to the government. So you want to be careful on that part as you're thinking about this, and as you're even thinking about putting people in your budget, how do you handle those individuals? Vendor payments and expense reports, I'm not going to spend a lot of time on this, only because expense reports really follow the same methodology as timekeeping. Employees own their expense report. It needs to be broken down by the cost objective. So what indirect or direct account does it get charged to? And for direct, what contract does it get charged to? Employee signs, employee controls it just like they did before with the timesheets. And as far as software out there, Expensify and Tally are the two hotter items that we see out in the field. I don't recommend doing anything fancy in a phase one world because it's too expensive. As you get to phase two, it makes a lot more sense at that point to go ahead and do it, especially if you have remote employees trying to pull information in. But you really want to keep the expense reporting as easy as possible to avoid all the administrative time that's required. Let's see, question, does my timekeeping plugins into QuickBooks so the timekeeping is linked with chart of accounts and task orders? Yeah, so this is an interesting question. We have seen where if you use the manual payroll function in QuickBooks Desktop, it's kind of hidden. You have to do a search for it. And you then link your chart of accounts, so your payroll items, to this third-party plugin. You will see that it can monetize your hours. The challenge in QuickBooks when you don't use what's embedded inside of QuickBooks, so if you use the QuickBooks payroll service inside of QuickBooks software, not QuickBooks payroll, but there's actually an embedded software, that will allow you to put the hours into QuickBooks. It'll automatically monetize those hours, put it in the right buckets, and then you process your payroll. Plugins, however, do not necessarily monetize your hours into dollars in QuickBooks, so it's not that clean, and it clutters things up. So, for example, the one to use the manual payroll in QuickBooks, the QuickBooks Desktop, the system automatically sets up a bank account for the payroll about to be paid. It's not a bank account, it's a liability, but that's how it does it. So there's this funky little thing on your balance sheet that shows up, but for this organization, it's worth the time. And then they just make a journal entry to reclass it to a liability at the end of a month. There's little quirky things. It's not that clean unless you use the embedded QuickBooks payroll service that's actually in the Pro software. Other than that, it gets clunky, very fast. Thank you for the question. So again, on the expense reports, coding on the bottom, the sooner the better. So this is one of those areas that's a compliance issue. The government likes to have contemporaneous and consistent coding. And the later you code, the less accurate the code usually is. So they like to know when you're coding things, and coding means how am I charging my chart of accounts? How am I hitting my books with this? What expense am I hitting? They want you to do that as soon as possible, like immediately. But most small businesses don't have the mechanisms to do that, so they give you a little bit of flexibility. But a year later is usually not the right answer. And if you use a purchasing system, the purchasing system is the soonest you can code a cost. So somewhere in between is the right answer. No later than the vendor bill. When the bill comes in, you don't want to be you can code at the bill time when your vendor sends you a bill on like MasterCard, Fisher Scientific, whatever your direct materials might be. You don't want to wait 3, 4, 5 weeks for that. You want to code this stuff immediately because you want to be able to say to them, the government auditors, that here's the timing of when we code, and the more contemporaneous, the more comfortable they are with the system. As far as billing goes, we have seen, and I'm a big fan of creativity and innovation, but we have seen some really crazy stuff when it comes to billing and how awardees handle billing. So we're going to go into the keep it simple part, and this is why I recommended the QuickBooks Pro program, is that all billing is done the same way. It's nice and easy. There's one process of I accumulate my costs. I then, at the end of each month or every 2 weeks or whatever your billing cycle is, I then prepare my billing documents, whatever it is that's required. And what doesn't matter if it's fixed price, government, commercial, it doesn't matter. So keeping it nice and simple. And I'm always amazed by how much pushback I get from clients on this one, because it makes no sense to have multiple billing mechanisms when you can only have one. Because then it makes everything clunky. You can't tell how you're burning through your contract necessarily. If you treat fixed price differently, then remember your indirect rates are being spread over all of your direct costs, all efforts. It's not based on just your one award. So if your company is doing more than one thing, it gets a little more complicated. So the bottom part there, accumulate costs starting with your direct labor, add your indirect costs, other direct costs, add your G&A, add your profit. So just roll, just like you prepare your budget, you prepare your billing. You just mirror exactly the format that you did on your budget. As far as what did you multiply by what to get to your award amount, this is the same exact thing. What costs am I applying my fringe rate to, which is usually direct labor? What costs is it that I'm applying my F&A to, which is usually everything that's direct cost plus fringe, unless you have NIH and, well, primarily NIH, where they may have equipment or subcontract removed from that calculation. But in the phase one world, it's usually pretty inclusive. It's not a modified rate. And that becomes your billing. And the example that I have is this company. Of course, I didn't do Acme. I did ABC instead. So I could be creative on this. They have a fringe rate of 20%, overhead rate of 50, a G&A of 10. So I went very complicated with this one. The grant gives them a 7% fixed fee. They had direct labor of $25,000, direct consultants of $15,000, and other direct costs of $5,000. If this was a fixed price contract, the awardee would have been able to bill $75,000. So this is something you will see every billing period that you bill the government. You'll see this if you cut off every 2 weeks with your payroll. If you're a biweekly payroll company, then you'll be doing these calculations every 2 weeks. You might do it monthly. It all depends on how you want to handle your cash flow. I always recommend always do this, the sooner the better. This way here, because you get real information on how you're doing on the award as the award starts to run out of time. So with this example, you can see where this is the same treatment between a cost plus fixed fee, a reimbursable calculation, and a firm fixed price, so a fixed price calculation. If you look at everything calculated, it's all identical until you get to the bottom where it says fixed fee. So fee of 7%, if you're getting reimbursed, you're getting 1% of your profit, which is the $5,005. So you get to bill the government $76,505. But if you look at the fixed price calculation, the government says you can only bill $75,000 this month. That's the fixed price number. So the fee becomes the plug. And if you think about the logic behind that, when all is said and done on a fixed price contract, your fixed fee represents your profit or loss on that project. So I wanted to demonstrate this because as you're thinking about what you're doing with your accounting system, these things are all going to come up again. Every single one of these things I'm presenting to you today is going to rear its ugly head in the future. And I'm trying to give you the simplified and consistent practice of don't make it more complicated than it already is. Questions? All right. Oh, wait. Thank you. ODC is other direct costs. So other direct costs are costs that are not segregated higher up on your budget when you put your budget together. Thank you for the question. On indirect rates, for phase ones, you are going to have either fixed price or safe harbor rates. The government doesn't usually negotiate indirect rates for phase ones. DOE tends to be a little bit of the outlier on this, but NIH is going to give you the 40% rate if you ask for it. NSF just gives you fixed price. DOD, usually regardless of branch, will give you a fixed price. Every now and then the Army will give you the quirky T&M. But for the most part, you're only going to see this with energy, where they look at indirect rates more in the earlier phase. So what a provisional rate is, it's a temporary rate. It's a rate that you're allowed to use to bill the government with the expectation in the future you're going to settle up. So when you're in phase two and you're working with DOD, you will have a negotiated rate. If you're working with DOE, you'll have a negotiated rate. NIH, you may go to a negotiated rate. It's somewhat punitive because they limit the amount of F&A you can get during the negotiation period. NSF, you can negotiate a rate with them. So the agencies allow you a negotiation provision. Some just do it naturally. Some do it by exception with possibly some consequences. So they'd like to steer you towards a safe rate if they can, but sometimes it doesn't work for your company. So you end up with this temporary rate when you have a negotiated rate. So this is the only time provisional rates matter. When you have a negotiated rate, you then have to settle up. You got to true up 6 months after the end of your fiscal year, which in most cases is going to be December. So this will be due in June. And the difference is between what you bill the government versus what you should have billed the government can go in either direction. So it's not an issue if you go over that number or go under the number, as long as the award continues into the following year, so you have time, and that there are direct activities that help absorb, or there might be indirect rate fluctuations from prior years or future years that might help offset some of these differences. But the final rates, it's always working towards a cumulative number of my award started June 1st of 2015. I incurred these costs in 15. I incurred these additional costs in 16, and then 17, and then 18. The contractor grant ends, and now the total dollar amount of what you earned needs to be equal to or greater than the total amount you got awarded, and that just means you're okay. If it's lower than, you may have a payback situation where you owe the government money. So that's why it's always good to keep this stuff going in as real time as possible. So as you're approaching the end of an award, you can see what's going to happen. You know what your indirect rates are, and you can see if there's any of those types of issues. Again, fixed price award, it's not an issue. You don't have to worry about those. And then some of the agencies, the way they do their fixed price, it may not matter. And you may have safe rates where, again, it won't matter. This is only when you have negotiated indirect rates. And then the government, NIH, is notorious for this when you negotiate a rate. They'll give you a ceiling rate. We're starting to see some of it with DOD, and this is usually the case when your accounting system is a mess. So if they can't assess their risk, then and they really need you for whatever it is they're doing, at times they'll give you a ceiling rate, but that's not really a good thing to have, because if they say to you, we're going to give you a G&A rate of 15% because we think that's a really cool number, and your G&A is really 25%, and this is the only work you're doing, you got to digest that extra 10%. And now that comes out of cash flow. Whereas if you have an adequate accounting system coming in, you're not going to have a ceiling rate with DOD. So again, this is DOD. NIH, if you negotiate, they're 99% of the time they're going to give you a ceiling. This is on the grant side. They are going to give you maybe 2 to 3 points above whatever it is you negotiate. And that means if you go over those rates, that's as high as you're going to get as far as the ceiling rate goes, and you don't recover anything above that. If you come below the provisional rate, then you may owe money back if not absorbed elsewhere. So indirect rates are very, very important. Let's see, unsolicited DOD SBIRs. All right, so the question is for unsolicited DOD SBIRs, do they allow the same format? Do they follow the same format on rates? I'm going to say yes to that because if it's under an SBIR, it's going to follow a very similar, the similar general rules. I can't imagine there's going to be an exception to it. There are program variations where sometimes the programs might give you a little more flexibility. We don't see a lot of that though. It's pretty standard. And then obviously in the end, they're all going to follow the federal acquisition regulations anyway. So a lot of this is all going to play into that. So planning, understanding your indirect rates is a very, very important piece to be proactive in. And then we have some reporting that's required. So when you're working with DOD, you're going to have reporting to DCAA. If you have any reimbursable awards, so CPFF, cost plus fixed fee awards, these will be due within 6 months of the end of the fiscal year. We always say get them done as soon as possible so you know the real picture of what's going on with your company. NIH would do the same thing. If you have an award that is greater than their safe harbor rate, it follows the indirect cost submission checklist. And but this has just changed, so I have to update this. They actually now are following the DOD or the DCAA format now. They're giving you the option of both, but reading between the lines, it looks like they're going to do the same ICE format that you see on the DCAA.mil website. So again, these reporting requirements when it comes to indirect rates is only when you have a negotiated rate. If you have fixed price, doesn't matter because you don't. The government pays you as long as you meet the terms and conditions of that award and give them all the deliverables. But on the cost reimbursement side, you're going to have a reporting requirement 6 months after the year end in order to settle up, true up your costs. And then sometimes these rates, you might use these rates going forward. You might make some dollar monetary adjustments to make the government whole or to make your company whole. Nice thing about DCAA is they like to keep you as close to zero. Zero meaning that you got what you earned as frequently as possible. That's always their goal. Administratively, it's very difficult for them to issue formal letters and review everything on time. But we will normally submit vouchers that have the new calculations in there. We'll use the new rates. They approve the vouchers. They may not give a formal letter at that point. But the goal is to keep the companies as close to zero as possible. So you didn't underbill so much or you didn't overbill them so much because they don't like when you sit on their money. NIH is the same way. As far as audits go, so DCAA will look at if you have to file an incurred cost submission, they will look at it for adequacy. So they go through an adequacy checklist, and anybody looking at DOD, they have phenomenal information on DCAA.mil. If you look at it, I think it's checklists and tools. You will see a lot of really good things in there that are actually very basic, so they're well written. And they're very useful. They will show you what an adequate accounting system is. You have to meet, I think, 10 or 13 points. If you meet all those, then that helps you with your pre-award. They have a form SF 1408. If those of you going through that, just do that in advance so you have it ready. This will tell you what you need for your accounting system if you don't have it already. They're going to ask you for it anyway when you get to phase 2. But again, try to get things operational. But their model's changing. So it started about 10 years ago. They fell very, very far behind on audits, and they started to get into this more low-risk model. So if your incurred cost submission is adequate, they throw you into a pool to assess the risk of your audit, of your incurred cost submission, and determine whether or not it gets kicked out for an audit. You don't know no one knows what the secret sauce is or anything like that. You've always got to be ready for the audit. So companies sometimes will go 2-3 years without an audit. Some companies will go 2-3 years with an audit. So there's that's what auditing is. Auditing is all about this randomness, right? So your system needs to be able to demonstrate everything that's included in this document called the incurred cost submission. And then you may or may not have a desk audit, a field audit. They may just accept what you gave them, and then you sign off on it, they sign off on it, and you move on. NSF, NIH, DOE, they will normally do compliance audits. So it used to be the old A133. So there's a compliance audit they now use where if you expend more than $750,000 in your fiscal year, you have a compliance audit due 9 months thereafter. So if you're a 12/31 year end, you'll have a report due 9 months after that. Expenditures do not include fixed fee, and they're not based on how much money you were paid or drew down or billed. It's based on physical expenditures. which means what were my total direct costs, what were my actual indirect rates subject to limits, and that total number, if that exceeds 750, that triggers the compliance audit. The compliance audit has a financial component to it. So there's a statement called the Federal Awards Expenditures that becomes an auditable document. There's usually some other financial related audit depending on the auditing firm, but they're looking at compliance. They're looking at your procurement policies. They're looking at whether or not you met the period of performance. Did you draw down the right money at the right time? They're looking at the skill sets of the individuals who are involved, their budgets, eligibility, debarment, suspension. There's a bunch of fun little equipment. Sub-recipients. So if you have subcontractors, you've got to be ready for the complexity involved there, where you have to look at the subcontracts and monitor them like you're being monitored by the government as the prime contractor. So those are the pieces that come up in these compliance audits. So they're less financial, those are a financial component. They're more about what's happening day to day with the actual procedures. So these two, if you think about the agencies, these two groups really function hand in hand if they were all together, but they're not all together. So they're very, very distinct and different. If your company does business with both groups, so DCAA or this other group, NIH, NSF, and DOE, and you go over the 750, you're going to have some fun auditing going on, audit issues going on. The thing with NIH, NSF, and DOE and the compliance audit is if it goes over 750, you will have an audit by an independent CPA firm. So you want to budget probably if you have one major award, so let's say one award that's triggering it, you want to budget somewhere around $12,000 to $15,000 per year you're getting audited in your budget when you're looking at phase 2. So you want to definitely factor that in. That usually gets left out of the out of proposals. So this is what I call the backwards approach to phase. So this could also be phase 1, by the way. Phase 1 and phase 2 budgeting is that usually what we see in the field is, and I've worked with many organizations over the years, is that there's an award limit of some numbers. Let's say phase 1 is $225,000. We all know pretty much what our direct costs are going to be. So we have a sense of person A and person B are going to work on this grant part-time. We're going to need we might need some equipment. We might need some supplies. We have a consulting expert that we're aware of. We're going to bring them into the fold. And in order to compute your indirect numbers, we take the ceiling amount, the 225, divided by 1.07. That's the fixed fee component. That result minus my direct costs, because those are usually pretty good. Everyone's usually good with direct costs, equals my indirect costs. So in other words, your indirect costs become a plug. Now the question is, if you're funded or have other financial resources, you could take that risk. If you're not funded and you're living by this award, so the company is sinking or swimming based on the award, you have to use a little more diligence when you're looking at your indirect costs. You want to make sure that you understand what they are, that the rates make sense, and that you're asking for the right thing, the right type of rate. So example, I have awardees that will go for a 50% fringe rate. And if you're a phase 1, chances are the only fringe you're going to have is payroll tax expense, which is roughly 8%, and maybe workers' comp 1%. And if you're a first award company, you're not going to have anything much more elaborate. You're looking at benefits in phase 2. You'll never absorb the 50%, but the 50% is fringe. It's called fringe. So when you're looking at how you recover your costs, you want to make sure you understand the nature of the cost. So we just say put together a budget, a very quick budget. It could be back of the envelope, and see what these are in total dollars. What are the nature of costs based on what I said earlier with the two structures, and then come up with what is the real number. And if that starts to squeeze your direct costs, then you start revisiting your budget, saying, okay, I could probably take $5,000 out of here and $10,000 out of there, and maybe I don't need whatever the indirect cost is. I'll go and use something else, or I might just do it myself. But then it's part of your G&A labor or indirect labor. But you want to be aware of that in the phase 1 and phase 2 budget process, because this is where we see the biggest problems. We have companies that have requested a 10% F&A rate. So in everything they have, they only get 10%. And they may not have requested a fee, a profit. So the profit usually gives you 7% more to play with, but the profit should be there for emergencies, not part of the planning strategy. Some companies don't go for the full 7%. They might be missing parts of it. The most flexible money you have in an award is the 7% fee. So you always want to go for that. The second most flexible number is going to be on the indirect side, because if you underspend on the indirect, it's okay to rebudget in most cases to the direct side. Government likes more of your expertise, and that's direct, than paying for the overhead, paying for the indirect side of your business. But you want to know those things. The right approach is known direct costs, so I know what they are. I know my indirect costs. I have a fixed fee of 7%. That equals my preliminary number. And if it's perfect, then you got your 225 or $1 million or whatever the number is. But then you have your management decisions that kick in to bring that number down to what the ceiling is, and then you have your award amount. So in other words, doing it from the direct cost and indirect cost knowledge standpoint helps you understand what it is you're going to put into your budget justification, what type of indirect rates you're going to use, and so forth. So in your budget justification, I always recommend doing your indirect cost budget based on your chart of accounts. So when you have an adequate chart of accounts based on the previous slide where I showed that sequencing, you want to prepare your budget so it's aligned with the two. So the chart of accounts drives the system. You're going to dump this into Excel. You're going to say, do I have rent? If so, how much? Do I have whatever it is? You go right down the chart of accounts. That jogs your memory. It's very rare that a company ever overestimates or overstates their indirect costs. It's usually the other way around. So the chart of accounts acts like a checklist, and it will help you just go through each item and make sure that you understand, A, what the cost is, so what is the nature of the cost, and B, do I really need it, and then C, how much is it? Your direct cost budget, you're going to use your proposal and award. There's the format that's usually provided by the agency. And then this is something that very few people do. Prepare your labor distribution based on anticipated labor needs. So labor distribution means if you're going to have maybe you and one other employee, you're going to do a little bit of direct or a lot of direct, a little bit of indirect. You want to know that as you're preparing your budget justification, because a portion of your indirect activities is going to be in that indirect rate. And a lot of times companies leave that number off. So they start spending time on indirect activities, but the budget can't handle it. The indirect rate budget can't handle it. Your fixed fee ends up supporting that, and then after that, you run out of money. Again, this is if you don't have additional funding. Any questions? Just getting revved up. As I say, what a quiet group, but everybody's muted. So I guess that's why. All right, Del, do you want to jump in?
Yeah, well, we definitely want to thank you, George, for the wealth of information you gave about accounting for your businesses. And really, that is one of the things that a lot of people have issues with when they're putting together their SBIR, STTR packages, just as pretty much every single one of our clients can tell you. When it comes to figuring out their indirect rates, figuring out their labor structure, figuring out their cost rates, their cost structures, it's a giant quagmire to people. And so we just hope that all the information today was useful to you as you start to hopefully win those awards. Because again, we're here to watch New Mexico small businesses grow. George, would it be okay for me to share your email with the participants today, just in case they...
Oh, sure. Yeah. Yeah, and if I can just add one thing there, Del, this is the passion of, this is why I do this, is that when I look at early stage companies and getting off on the wrong foot on just knowing there's a lot of stuff that's involved here, that reacting to an award that's not going to provide you with what you need to be successful during that 6 or 9 month period on the phase one, it's a very, very difficult process on the awardees. And as you start to accumulate data, so transactions, it becomes a very, very costly part of your expenses to fix it later. And that's why, if you notice, the point of emphasis here is really just to get started, to get off on the right foot in the first place. This is why we set up what we call the SBIR Academy, which is an online LMS, a learning management system, to get the phase zeros and phase ones going. So they have an opportunity to really get off on the right foot, and which saves a ton of money down the road. And that's really the important piece. We've just seen so much. And again, being on the awardee side, I worked with NASA and the Air Force, and having gone through it, what appeared to be very, very complicated was not as complicated. It just made sense after a while. And what we find out as companies get off on the right foot is that the questions they're asking become more strategic. It might be around commercialization. It might be around, we're looking at our first or second hire. What's the impact on my organizational structure? Those are business questions. And that's really what I think is important for new awardees to be thinking about. And that's why we started off with our tagline of "You're a business first, the government is just one of your customers." It's that running this thing like a business. And that becomes challenging. We've worked with many firms over the years, and it's very, very challenging, and we get it. There's always this, let me push it off to phase 2, I may not get my phase 2. And then I say, well, if you do get your phase 2, the financial risk is so much lower getting started on the right foot than it is cleaning it up in case you get the phase 2. So that's always that's the debate that goes on as far as when do I start this process? And we always say the sooner the better. So thank you very much for that. And yes, feel free to share my email address. Any questions come up, really just feel free to ask me the question. I'll be glad to answer them.
Well, and it looks like you got a couple more that popped up in the chat there. One person was real interested in the SBIR Academy you were mentioning there.
Yeah, so let's see, payroll service. So Gusto, I'm going to recommend Gusto for the payroll service because we've recommended others in the field, and this is in Chicago, Berkeley, all over the country. It's here in Boston. They're all using Gusto. So, and I think the driver on Gusto, A, it's affordability, but B, they have benefits piggybacked with it. So there's some things you can add where they're the administrator. So it's almost like one-stop shopping. So one I will recommend against. Nobody go. I wouldn't use a TriNet. It's way too expensive, too complicated. Be very careful if you're looking at the full service side where benefits are added, because your costs get a little prohibitive very fast. But as far as the academy goes, what the academy is it's about a 2 to 3 hour learning management system. So there's two pieces of it. One is here's how your cost structures work. So what's a direct cost? What's an indirect cost? How do I handle payroll? Very generic type of, here's your chart of accounts. The second module is how to use QuickBooks in the government contracting environment. So it actually walks you through the chart of accounts, how do you record the transactions? How do you roll these costs up? How do you generate the invoice? So everything I talked about today, it will show you how to do that in QuickBooks with a bunch of checkpoints. So we give you data, you put the data into a test data file, you get the same results, you finish, you get a certificate, you download your new data file, which is a blank data file, you open that up in your QuickBooks Pro desktop software, and you're ready to go. Your accounting, it's turnkey, your accounting system is ready to go. So that's what the academy does, and then our office does follow-on training. I think there's roughly 4 hours over the next 6 months of any types of questions that you have. We're answering those questions related to the adequacy of your accounting system, how to code transactions, understanding your costs. Things are transaction specific sometimes, right? You might want to buy a piece of equipment versus lease. Is my employee really doing direct activities versus indirect activities? Those are things we can help you with as part of the academy. So we put that out there just as something that phase 0s and phase 1s can go to, because there's usually not a lot of support at that level that's more affordable. So we did put that together. We're updating it now because of the acquisition of our firm. So what you'll see there is it's still under Mocha CPA, but you'll see it in that model. But everything in there is relevant, and it's very, very helpful. But you stay engaged for the 6-month period of time during your if you're in a phase 1, during the phase 1 award. How do I access the academy? If you send me an email, then I will have, we have Rudy Cudmore here is our SBIR Academy guru, so she would give you the link to what you need. She'll give you the overview, what goes on, how the whole thing works, how you get access to it. So send me an email on that part of it. And Del, do they all have my email address? I never put it up on the screen. I don't know why.
I will actually make sure that all the attendees and even the people that signed up get your email address, George.
Okay, very good.
And I think we have one question in the audience here. Go ahead.
Yeah, George, I had a question about the regulations and compliances. For a new company, would it be best to start out going federal or stick to the state guidelines and then move up federal?
Wait, say it again. I just increased my volume. Go ahead.
When you're talking about the government awards, does it depend if it comes from national or state, whether or not you have to stick by state guidelines and or regulation, or should it be best just to set up with federal regulations and guidelines? That way there's no...
Yeah, I would start, that's a good question. I would recommend starting with the federal guidelines first. And then if there's any state variations that exist, then those states are usually modifications to the federal guidelines. It's very rare the federal government reacts to the states. It's usually the other way around. So I would go federal first and then state after, if necessary. Are you talking the context of award rules, or are you talking about setting up a business?
Well, I'm talking just with the award rules because...
Then that would be my recommendation. Because usually what you're going to see is you're going to see references to the Code of Federal Regulations, CFRs. You're going to see some things might be, like you might get supplemental funding. So we see this coming out of incubators in other parts of the country. And when you get supplemental funding, they tend to start at the federal level. So there's some federal nuance to it, although some states just go in and they're writing the rules as they go along, because a lot of this is new, especially with the incubator models, connecting with the SBA and so forth, that these areas are, they're defining new things, but they still start at the core of this accounting system is adequate. Someone else kind of looked at it. And then at that point, you're going to have to tweak whatever the numbers are to be specific to what the state says. And you're going to find that, by the way, with agency to agency at the federal level too. You're going to find that there are things that DOD will let you do that NIH and NSF will never let you do, like independent research and development. DOD will allow it for the most part. NIH and NSF don't allow it, and then they put it into a denominator when they compute your rate, so it's like a double negative. So you have those at the federal level, and those are called agency guides, where there's these deviations. DOD has the DFARS, so the Defense Federal Acquisition Regulations, which are little exceptions or add-ons to the Federal Acquisition Regulations. States tend to behave the same way. And what that means is states will have their separate set of rules, and you're just adapting the federal way that you did things to what the state's asking for. And for the most part, you'll be able to do that with the accounting systems we're talking about.
Thank you, sir.
You're welcome.
All right.
Other questions?
I think that actually wraps us up.
All right, very good.
Again, I want to thank Karen, Penny, and George today. Well, I thought it was a really great session. And for everyone online, you'll be getting a series of emails from both ourselves as well as Mocher CPA on things like the presentation and how to access the to get George's email address, so that if you have any other questions that come up, we can directly put you in touch and you can directly ask George. Otherwise, everybody have a wonderful afternoon.
All right. Thank you very much, everybody.